Hello, investors. Let me begin by saying investing is not a one size fits all. Generally speaking, the higher the risk, the higher the reward. Well, with that being said, I can't tell you how many times I've been told, Gio, what's up with GameStop? Are you going to invest in it? Well, my short answer is no. And this is the reason why. You see, GameStop is considered a meme stock, and it's very different from the kind of stocks that I do. The biggest difference is the fundamentals. You see, when you talk about a meme stock, it trades based on hype and momentum. But when you talk about other stocks, like let's say Starbucks, you talk about the fundamentals and what you see that company doing in the future. I'm not saying that GameStop is going to go to zero or that it's going to go down. But what I am saying is that GameStop is very volatile and it's very risky. At the end of the day, there's no such thing as a risk-free stock. If you've seen my channel before, you know I don't BS around the news and I get straight to the point. So before I give you the red flags that I see in GameStop, here's a quick history lesson so that both you and I are both in the same page. You see, a couple years ago, about 2021, GameStop, their stock was going down. And hedge funds, they were actually shorting the company because they were saying, you know what, I bet you it's going to continue to go down. So their mentality was this: it's a tech-driven world. So instead of people going inside the stores and purchasing their video games, the people would just buy the video games in the game console. And also remember, it was COVID during that time. And during COVID, not many people were going outside. So if you don't go outside, you don't go into the store and you don't buy anything. And the thing was, someone noticed. And when they noticed that it was getting shorted a lot, they started buying. Not only that, but they started telling other people to buy. And now the stock was going up. And remember, the stock and the company, they're the same but different. The same but different. Have y'all seen that meme? It's hilarious. But anyways, so while the stock was going up, the company was staying down. And as people kept buying it, it kept going up and up. And remember that these hedge funds were shorting it. They were actually getting forced to sell it. And it going up was even making it more up because there's more upward momentum because they were being forced to sell it. And eventually, basically the investor like you and I, we got screwed over because they got to a point where they would freeze the stock. And some exchanges, you could sell it, but you couldn't buy it. And it's like, it's downward momentum. I lost a lot of money on those AMC, GameStop. Now that you understand GameStop's past, if you want to invest in GameStop or even currently have a position there, you fall under one of three categories. The first category is the person that's trying to make a quick buck and take off. And there's nothing wrong with that. You buy the stock, it goes up, and then you cash out, you made money. Congrats. That's what investing is all about. Make some money, you know? The second category is the people that want to stick it to the hedge funds. You see, they're tired of the people with the deep pockets always having it their way. And the investor's mentality is, we're either going to take all of it or we're going to leave with nothing. And that's where the term HODL comes in. Diamond hands, to the moon. All these terms, like that's where it comes from. You know, they want to hold it and they just want to stick it to the big person, you know? And then the third category is the people that have lost money and they're just hoping for the stock to go up and to have an opportunity to just cash out and just forget about it. Lesson learned, move along. So those are the three categories. Now, there are, I guess you could say, large gatherings, a large people based where, like, how would I say this? there's a large following base on some people that like they're known for the stock. Like for example, here in GameStop, there's a person called Roaring Kitty. I know the term sounds funny, but hey, this is the kind of world you live in now. So this guy, Roaring Kitty, he's known because during the first time around with GameStop, he's the one that noticed like, hey, they were shorting. So like, here's the thing. He hasn't posted anything in like 3 years. And all of a sudden, he posts this picture. Yeah, this picture. This was enough to send GameStop soaring. Oh my God, it went straight up. And now the $1 million question is it going to continue to go up? Or is it going to consolidate? Or is it going to go right back down? So this is what made GameStop like really pop. Here's red flag number 1. According to Fortune, GameStop stock is crashing after the company reported weak sales. And, keyword, it cashed in on the meme stock revival by selling 45 million shares. You know it's a problem when the actual company is selling its own shares. How crazy is that? Red flag. Red flag number 2. According to Watch Guru, GameStop, GME, and AMC entertainment stocks halted, that means it stopped, 34 times combined today. Remember I was telling you that sometimes it stops the stock? Yeah, it happened 34 times on the time that it was posted. And last but not least, the big red flag is this. According to Google, in the case of GameStop, during most of the regular trading day, its shares are halted whenever their price rises or falls more than 5% in a 5-minute window. So in other words, if the stock price goes up 5% or more, or down 5% or more within that 5-minute window, it stops. So during the last 25 minutes before the stock market closed at 4 p.m., the rules change and the prices can fluctuate up to 10% before the halt. It's too risky for me. Now here's my disclaimer. I am not a financial advisor. This is not financial advice. This is just what I'm doing. Let's take a look at the latest news in the stock market. Now, if you didn't know, you could also find me on Instagram. I'm under Investing with Gio. There in the story section, I post like some of the latest news in the crypto and stock market. So let's take a look at the weeks between May 6th to May 20th to make sure that we didn't skip anything. So first thing is first, Alibaba missed earnings. I must say that was a shock. For those of you that don't know, think of Alibaba as a Chinese like Amazon. This is very bad news because it shows that the economy is still struggling. Use extreme caution when trading Chinese stocks. It's still very volatile. Now, yes, like they already have the president getting another term. Yes, COVID, they're not as strict as they used to be. But at the end of the day, their economy is still struggling. So just be careful with Chinese stocks. When they did report that they missed earnings, look at this. They went down over 6% on the news that they missed earnings. We did talk about how GameStop halted 34 times. Let's see, April, the CPI report. It shows inflation is up 0.3%. Even though it's up, it's softer than expected. So remember, like, expectations also mean a lot. So because it's softer, the stock went up. CPI comes in at 3.4% annual rate for April. But remember, the Feds, they prefer core CPI. And that's at a 3.6% annual rate. Now, as a special bonus, on May 22nd, in the after hours, NVIDIA, ticker NVDA, is going to report earnings. This is a really big deal because NVIDIA is the leader for AI, artificial intelligence chips. So if they beat earnings and everything is done well and they don't say nothing that spooks the investors, the markets are going to continue to rally up. But if they miss earnings or they say something negative, it does have the potential to shake up the stock market. Now remember, there is an AI bubble, so just be careful. With that being said, this brings you to the end of the episode. If you did find this informative, please don't forget to like, subscribe, and hit that bell icon so you can get notified whenever I post new videos. Until next time, good luck investing.